We can't rewrite financial history,
but we can write our industry's future.
It's time to reignite our sense of purpose
and shape a financial system that's ethical,
fair, ready to solve problems.
We have it in us.
We have always had it in us.
The future of finance starts here.
It starts now.
It starts with you.
All right, well, good evening, everyone, and welcome to CFA Society Colorado's 12th Annual Forecast Dinner. A little bit. Thank you, Brian. Oh, there we go. That's our parliamentarian in action. It works. Well, thank you for joining us tonight, and I hope you're excited for a delicious dinner and enjoying some of the cocktails, the wine, the beer. Hopefully that Williams & Graham Blackberry Smash, that's courtesy of Denver's #1 bar over in the Highlands neighborhood. If you haven't checked it out, it's a great place. My name is Jordan Kuntz, and I'm the current president of the Colorado Society. The recent market volatility has no doubt drawn the attention of your clients and your firm. But as investment professionals, we can't control the markets, but we can control our actions. Now, the video you just watched and perhaps heard a little bit of is part of the Future of Finance campaign, which is a multi-year effort by CFA Institute to motivate and empower the world of finance to become an environment where investor interests come first, markets function at their best, and economies grow. As part of this, we encourage you to join over 1,100 other firms worldwide in 35 countries by adopting the Asset Manager Code of Conduct. And that's available online, but it is we're seeing that come up more and more in RFPs and a number of institutional requests. So by all means, check that out. I know a number of the sponsors here have already taken part in that. Thank you. And if you haven't had a chance to look at it, please do. It is an honor and a privilege to have you here on Colorado's biggest night for investment professionals. Now, while this is the Society's marquee event of the year, we do have a variety of educational, social, and career events throughout the year. We have 1,100 local members here in Colorado, and then of course, there's the broader investment community of which you are all a part. For further information on the Society, please visit cfacolorado.org, and you'll learn how to sign up for future events such as our upcoming Investment Research Challenge. We have some students here tonight who are part of that, and that is coming up on Monday. It's a global competition worldwide, and the final will actually be in Chicago later this year. But it's a fabulous opportunity to attend and cheer on perhaps your local alma maters. Now, an event of this size and scope doesn't come together in a vacuum. And there are a number of people to thank for the tremendous effort in making tonight a success. So first, Tanya Dyack. Tanya, are you here? She might be attending to a sponsor. We'll give her a big round of applause when she comes back. But she volunteered her time to oversee major planning from the very beginning all the way through to the details tonight, which she's attending to right now. And we're very, very grateful that she returns to us every year to help coordinate this effort. So again, let's give Tanya a big round of applause. Now, there's two other key members of our local team out here, Lisa Rice and Amber Fowler. They coordinate so many details for us throughout the year, not just for tonight, but many of our other events with the Society in general. So many thanks to you both for all that you do. Amber and Lisa, if you're in the room, I see Amber. Lisa should be around. You might have met her before. Please give them a round of applause. I would also like the local board members to stand and be recognized at this time. Now, these individuals volunteer their time to advance the goals of our society and the Institute, which is something that we all benefit from. They're all volunteers. They're not paid. They're putting in hours and hours on your behalf, so please give them a big round of applause. And additionally, I would like to take a few moments to thank our sponsors for the Forecast Dinner for helping us to host a great evening, and I hope that you and your guests are thoroughly enjoying yourselves. very special thanks to our platinum sponsors, AeroPoint Partners and Janus Capital. Thank you very much. As well as our gold sponsors, Alps, Denver Investments, OFI Global, and Wisdom Tree. We thank you for your partnership. Now we're going to take a brief break while everyone gets served food, and then we'll be starting up shortly thereafter. But get the most you can from the event, connect with your colleagues, and enjoy the presentations. Thank you so much.
Excuse me. We're going to go ahead and get started. Please continue eating. I want to say thank you for taking the time tonight to attend the Colorado CFA Society's 12th annual Forecast Dinner. My name is Dave Schrock, and I'm a member of Janus Capital's Institutional Client Development Team. And on behalf of Janus and my colleagues, we're certainly pleased to partner with the CFA Society at this event, as it's always been a really high-quality gathering where not only there's a plethora of relevant, timely information is shared, but I think more importantly, unique market insights are highlighted. And tonight, to kick things off, I have the distinct honor and privilege of introducing Dr. Allison Felix. And Dr. Felix will be discussing some of her insights as it relates to the broader economy, but also more specifically the local economy here in Colorado. Dr. Allison Felix is Vice President and Denver Branch Executive at the Federal Reserve Bank of Kansas City. And in this role, she serves as the bank's regional economist and representative in the states of Colorado, Wyoming, and northern New Mexico. Dr. Felix works very closely with the branch's board of directors, is responsible for briefing the Kansas City Fed's president, a member of the Federal Open Market Committee, on economic and business activity in the Denver region states. Dr. Felix's research focuses on public finance and labor issues with an emphasis on tax policy, state and local government finance, and the economics of education. Dr. Felix joined the Federal Reserve in 2007 as an economist in the Regional Affairs Department in Kansas City. She was appointed Denver Branch Executive in 2012. And she holds a PhD and a master's in economics from the University of Michigan and a BA in mathematics and economics from Kansas State University. Please join me in welcoming Dr. Allison Felix.
Well, thank you very much for the opportunity to join you this evening. Thanks to Jordan and to the other board members for this invitation. It's an honor to be with you tonight. I'm going to talk a little bit about what's going on at the national level, just to put what's going on in Colorado in a little bit more context. So I'll start here looking just at real GDP growth over the last few quarters, and then also what's expected this year and over the next couple of years. You can see now that we've been in recovery mode for several years. Growth in 2015 was modest, perhaps not quite as strong as expected, especially when you look at the fourth quarter number that's likely to be coming in here shortly. But if you look towards 2016 and look at the first gray bar there, you can see that the Federal Open Market Committee is expecting GDP to grow somewhere in the range of 2.3 to 2.5%. This year, which would be a little bit faster than what we consider a trend rate of growth. So it should be strong enough to continue to pull down unemployment rates in the U.S. economy. So I wanted to mention some of the reasons that we're expecting growth to continue, perhaps growth to pick up a little bit in 2016. And I think one of the primary drivers is that the labor market continues to strengthen. If you look at payroll employment gains over the last 12 months, we've been averaging about 221,000 new jobs per month. And if you look over the last 3 months, it's been even stronger, about 284,000 jobs per month. Of course, there are lots of ways to look at the labor market, but by most measures of labor market activity, you see a strengthening overall in the labor market. You can see that job openings have increased. The quit rate is at a post-recession high. Employment to population ratios are now gradually increasing. And we're finally starting to see a little bit stronger wage growth. We're still not seeing robust wage growth, but we are starting to see a little bit more of a pickup. In addition to the strengthening in the labor market, consumer spending is also a big reason for a positive outlook in 2016. Consumer spending makes up about 70% of the U.S. economy. And of course, the most recent data point that we had on retail sales was quite disappointing. A pretty weak December number came in. But if you look at core retail sales over the past year, they're up about 3.2%. So still fairly moderate growth on the consumer side. I think what leads to an optimistic outlook on the consumer side for 2016 is that there are very strong fundamentals in that sector. Consumers have faced low gas prices for some time, and gasoline prices continue to fall. We're starting to see more income in the US economy, both through job gains and also through wage growth. On the wealth effect side of things, home prices continue to increase, and that should help consumers feel a little bit more confident. I'll mention in a minute, one of the risks is going to be the stock market side of things, which is having the opposite wealth effect right now. Consumer confidence remains fairly high, and it has been increasing despite the recent volatility in the markets. And debt levels are much lower than they have been in recent years for US consumers. And if you look at debt servicing levels, at the lowest level they've been in 35 years. In addition to consumer spending, the construction sector also looks poised to add to the economy in 2016. So all of that said, I think there are lots of risks to the outlook. So this is kind of the baseline forecast. I think it's in line with a lot of private sector economists. But certainly, so far in 2016 has highlighted that there are many risks to this outlook. Regionally, I think one of the biggest risks is going to come from the energy sector. Of course, we've seen the decline in oil prices for some time now, but oil prices continue to come down, are at lows that some forecasters weren't expecting, and they look like they're going to be low for some time. So I think especially when you look at some energy-concentrated states, that's certainly a big risk. A lot of the concerns are global in nature. So as the US economy continues to strengthen, the global economy has at least some weak spots with a lot of attention focused on the Chinese economy. That's had several implications, but one of those implications has been that the dollar has strengthened considerably over the past year. So that's really weighing on our manufacturing sector, on our exporting sector, and that looks like it's going to continue to be a drag on growth. And then the last risk that I'll mention is just some of the volatility that we've been experiencing over the last couple of weeks. Certainly the stock market doesn't have to be an indication of what's to come for the US economy, but to the extent that it has wealth effects and then can influence confidence, both business confidence and consumer confidence in the market, certainly that could dampen overall US GDP growth. Turning to look at, this is US income and consumer expenditures. I mentioned that consumer spending makes up about 70% of the US economy. Here you can see that income has now been growing at a faster pace than consumer expenditures over the past year. And you can see historically these lines move pretty closely in line with each other. So this is just one way of looking at the fact that savings has been increasing in the US economy, and so consumers are fairly well positioned to spend more money in 2016. Looking at the inflation side of things, of course, inflation has been running well below the Federal Reserve's 2% target for several years now. You can see, looking at the black line here, which is labeled headline inflation, which includes the prices of all goods and services purchased by consumers or on behalf of consumers, that prices have increased just 0.4% over the past year. Of course, one big factor weighing down that overall headline number has been energy prices. So when you take out energy and food prices, that gets us to that core inflation number. But even core inflation has been running well below that 2% target, increasing just 1.3% over the past year. On the core inflation side of things, it looks like there are a couple of drivers there. One driver has been the strengthening dollar. And the goods that we're importing are now cheaper, and that's certainly weighing on inflation. Of course, as the dollar stabilizes and as oil prices stabilize, that should help to bring inflation closer to that 2% target. Turning now to look at labor market conditions in the US overall, the black line here labeled U3 is what we would typically think of as the official unemployment rate. And currently in the US, the unemployment rate is 5% and has fallen about 0.6 of a percentage point over the last year. When you base that 5% and look at a longer time trend, so I've shown here back to 1980, you can see that the current unemployment rate is below the historical average for unemployment rates. So at least by that measures, labor markets in the US look fairly healthy. Of course, during the recent recession and recovery, there were several different factors playing out as it relates to the labor market. One of those was that many individuals exited the labor market during the recent recession. And so even those who may want a job, who would take a job if offered one, aren't actively looking for work. And if you add these discouraged workers back into the unemployment rate, you'd get an unemployment rate in the US of 6.1%. Perhaps even a bigger problem for the US economy is the line labeled U6. And this measure is going to add in workers who are working part-time, but they'd prefer to have a full-time job. And by that measure, unemployment or underemployment is at about 10% in the US economy. So although we've made substantial progress in getting back to a healthy labor market, we still do have a decent proportion of the US economy that's either unemployed or underemployed. So now turning to look more regionally, and you'll see a similar theme play out here on many of the slides. By most measures, Colorado's economy has been outperforming the nation overall during this recovery period, and in particular, the Front Range of Colorado has been outperforming the nation. Certainly other parts of the state have not recovered at the same speed as the Front Range. So here, this is a snapshot of unemployment rates across the state of Colorado. Currently, the unemployment rate is 3.6%, and it's fallen considerably over the past year, just as the unemployment rate has fallen in the nation. In addition, if you look at those U5 and U6 numbers for Colorado, you can see that they, for the most part, look fairly healthy, with 4.5% unemployment, even if you include discouraged workers. And the only number that remains elevated in Colorado from where we were in 2006 is that U6 number. So today, that U6 number is measuring 8.4%. And that was 7.9% in 2006. So really for Colorado, for most of the parts of Colorado, the labor market is fairly healthy. And in fact, in parts of the state, we're seeing some tight labor market conditions. And so you're starting to see that spur some wage gains across the state. If you look at payroll employment growth for Colorado in the US, I think this really highlights kind of the trend that I've been talking about, with much stronger gains in the state of Colorado compared to the nation. You can see that both areas' jobs have been increasing over the last 5 years, but at about double the pace in Colorado compared to the US. Looking just over the past year, employment growth has slowed a bit in Colorado, increasing just 1.8% compared to employment gains of over 3% the previous year. Now, most economists locally expect that number to be revised up, probably closer to 2.5%. But even with an upward revision, that would be a little bit slower than what we saw in 2014. And I think there really are a couple of reasons for that. The first, as I think everyone can guess, is the energy sector. No question, we've had quite a few layoffs in the energy sector. We're seeing that translate into job losses across the state. The second reason is a little more nuanced, and then that's just the fact that we have a tighter labor market in Colorado. So the initial gains that we were seeing was kind of a makeup period, a recovery period for the Colorado economy. And as we get tighter labor markets, it's harder to fill job openings. And in fact, if you talk around the Denver, Boulder, Front Range area, I think it's a common trend to hear people talk about how I can't find a person to fill a specific position. So you hear certain high-tech positions difficult to find. Construction has been an area where workers have been hard to find for some time. This next chart shows payroll employment growth by industry over the past year, with Colorado in blue and the US in black. And you really see a different trend in 2015 compared to 2014 in Colorado. In 2014, almost every industry was growing in the state, and you're starting to see a little bit of a shift there. So if you look at the bottom, you can see that the energy sector now contracting. We've lost about 4% of our employment in that sector over the past year. But you're also seeing some related industries starting to have some problems as well. So you can see Transportation employment is down. Wholesale trade employment is down. And you can see some weakness in professional and business services. The real positive for Colorado is at this point, we have a fairly diverse economy. So you can see some sectors there at the top of this chart that have seen really strong employment gains over the past year. In particular, the construction sector continues to be a very strong sector for the state economy, particularly, again, in the Front Range of the state. The next category there, leisure and hospitality. The tourism industry has been very strong for the state of Colorado, both in the metro areas and also in the resort areas of the state. In addition to strength in the tourism sector, this is also going to include spending by residents who are spending more on entertainment type purchases. So as job gains have continued, as income gains have continued, you see residents spending more on things like going out to eat, traveling more, skiing more, and all of this is going to be in this category. The healthcare sector also remains strong in the state, and you can see that the financial services sector has also added jobs at a pretty good pace over the past year. So I thought I'd focus first on some of the real positives for the state of Colorado, because certainly there are some risks both for Colorado and for the nation, but I think there are a lot of good things. So I'll start with the positives, and I think one of those is net migration. So here, anything in a shade of blue indicates that the area is gaining more new residents than it's losing. And you can see that many parts of the state are experiencing pretty fast in-migration. And in particular, in-migration in Colorado is about 3 times what it is in the nation. Overall, I think this has been a good thing for the state. We tend to attract a fairly young population, fairly highly educated, and it's helped attract companies into the area. Looking at this next chart here and looking at the construction sector, which has also been a real strength for Colorado, this shows residential permitting activity. Again, as probably all of you know, if you live in the area, home inventories are at very low levels. So when you look at a month's supply of homes in Denver, we're at about a 1.3 months supply of homes. Even for the state as a whole, we're at a 2.6 months supply of homes for the state. And these numbers are well below what we would consider to be a balanced market. So anytime you have inventories that are this low, we'd expect to see more construction activity and we'd expect to see home prices rise. And we're really seeing both of those things. So here, I've specifically shown permitting activity because this breaks down multifamily permitting activity and single-family permitting activity. You can see that the multifamily sector was really the initial driver of residential growth in the area. Just over the past year, though, that trend seems to be reversing a little bit, with multifamily permits down 9% in 2015, but single-family permits up 19%. So some of that heating up in the multifamily sector seems to be maybe reversing a little bit, or at least cooling off, which I think could be a good thing for the region. But overall, you can see that in Denver, multifamily permits now make up 45% of all permitting activity, which is a much larger share than what we were seeing in the years leading up to the recession. In trend with that, this shows home price appreciation. Here you can just really see the difference between Colorado and the nation. Of course, here locally, we did see home price declines during the recent recession, but at this point, it's almost hard to remember that occurred. We've had very strong home price appreciation since then, with home prices now 31% above where they were at previous peak levels. And that's in contrast to the nation, where home prices are about flat with where they were in early 2007. Another positive for the construction sector is to look at vacancy rates in the area. Here you can see vacancy rates have been declining across all of the spectrums. Office vacancies are down, retail vacancies down. Industrial vacancies are particularly low in Denver. And multifamily had been trending down, but just over the past year is starting to tick up a bit as more construction activity and units have come online. Also, I'll mention here just briefly, you can see the small uptick in office vacancy rates, and you can see that the energy sector is having some effect on that market here locally. Likely going to have a little bit more of an effect here over the next year But when you look up at the buildup in construction activity in the mid-1980s compared to what we've had recently, we wouldn't expect the same kind of downturn we saw in the 80s as we would expect this time around. We look much better positioned currently. I mentioned tourism is another of the very strong sectors for the Colorado economy. This shows hotel occupancy rates on the left and real room rates on the right. You can see that in 2015, we were near 10-year record levels for both of these measures. In addition, if you look at things like national park visits, up very strongly over the past year, up 19%, with the Rocky Mountain National Park at its peak levels historically. So those are some of the positives. So strong job gains, wages are increasing, strong in-migration, construction, tourism, the service sector, all doing very well. So what are some of the risks to the outlook? And I'll start by looking at the global economy. That seems to be one of the big concerns. And I won't spend too much time here, but really you can see that China playing out and having some effect as their economy slows. A number just released today that their economy grew 6.9% in 2015. In addition, you can see that energy is weighing heavily on some countries across the globe. So you can see big downturns in Russia, Brazil, Saudi Arabia expected to slow slightly, Canada also slowing sharply in 2015. The good news here is that the current expectations are for growth to pick up a little bit in 2016 compared to where we were in 2015. One of the effects of that weak global economy is that the dollar has strengthened considerably over the past year. So this just shows the nominal trade-weighted exchange value of the dollar, and you can see a very sharp rise over the last few years. So what does that mean locally? Looking at manufacturing activity, this is one of the sectors that's been hardest hit by a strong dollar and a weak global economy. The black line here shows a measure of US manufacturing activity, and the blue line shows a regional index of manufacturing activity. Both of these numbers are now below 50, indicating that the sector is contracting. You can see more regionally in the 10th district of the Federal Reserve, which includes Colorado, that really for most of 2015, manufacturing sector was contracting, primarily due to a slowdown in the energy sector, and then also due to a slowdown in exports. The positive in the local index or the local survey that we conduct is that the last 2 months of our survey, manufacturers are now expecting a small pickup in activity over the last 6 months. And so that's somewhat of a new trend. So hopefully the sector is at least stabilizing a bit, if not returning to previous levels. The other effect, obviously, of a stronger dollar is going to be on exports. You can see that in 2015, Colorado exports declined slightly. You can see that the big decline coming from Canada, which is a big trading partner for Colorado, and certainly has felt the effects of the downturn in oil prices. Overall, Colorado is a little bit more insulated from a downturn in exports, exports making up just 2.7% of GDP in the state versus almost 10% nationally. And then the last sector I thought I'd look at is the energy sector, and I see this as probably the biggest risk regionally for the outlook. So here are some pictures that you're probably somewhat familiar with. Of course, over the past year, we've had a very sharp decline in oil rigs. And then production held up for a lot of 2015, and now we're starting to see a small decline in oil production, both in Colorado and at the national level. But because production was slow to come down, really didn't give us much price support. So prices have continued to fall lower. At the Federal Reserve Bank of Kansas City, we conduct an energy survey. We've been conducting this for a couple of years now. We found it very useful during the recent decline in oil prices, so I thought I would point out some of the indicators from this survey. Similar to our manufacturing survey, here we're asking energy contacts, are conditions better this quarter, worse this quarter, or about the same? Anything below 0 would indicate that that activity is declining. And so perhaps not surprisingly, drilling activity, access to credit, profits, employment, employee hours, and wages have all declined for the entire 2015. The other discouraging feature of this chart is that if you follow the dotted lines, that's what's expected over the next 6 months. And so you can see that the sector is expecting additional declines across the board. We also have the ability to ask special questions, and I think that's been one of the most interesting parts of the survey, so I thought I'd share just a couple of the special questions that we've asked. This one shows the change in energy employment, both what actually happened in 2015 and then what's expected to happen in 2016. The bad part of this chart is that you can see that most firms are expecting an additional round of layoffs in 2016. The positive, if there is a positive to take away here, is that the declines are expected to be somewhat smaller than they were in 2015. So you can see that most of our contacts expecting declines less than 10% of employment this year, whereas a significant number were expecting larger declines in 2000, or actually experienced sharper declines in 2015. And then this last chart shows several different indicators of the energy sector. So I'll point out just a couple. Of course, I've shown West Texas Intermediate oil prices and then futures prices, and you can see the dramatic decline in oil prices, and you can see oil prices expected to remain low for quite some time. But I'll point out a couple of these red dots that are marked along the way. When we first asked contacts in September of 2014, what's your break even for oil prices? On average, the break even oil price was $78 per barrel. And again, this is in the 10th district region. So including Colorado, Wyoming, Oklahoma, New Mexico are kind of the big areas for energy activity in our area. We asked the question again just 6 months later in March of 2015, and break-even prices had fallen to $60 per barrel. So you can see just a significant decline in break-even oil prices over just that 6-month time period. A lot of that was due to a restructuring of contracts with service providers. So producers immediately went to servicers and said, we need lower prices, and in general, were successful in negotiating lower prices. The other big impact there is that, of course, the rigs that were shut down were the least productive rigs. So you're left with very productive oil drilling rigs that are left, and so break-even prices have fallen. So I think that's a good sign for when the oil sector is going to come back. I think the bad sign for the energy industry is the questions that we asked: when do you expect to see, or what price of oil do you need for a substantial increase in drilling? When we first asked that question in June 2015, on average, contacts reported that they needed to see $73 per barrel. That price has also fallen. We asked that question again in just this last December, and the average price was $60. So good news is that the price they need to increase drilling has fallen. Bad news is that we're not expected to hit $60 per barrel for at least the next couple of years. So overall, I will wrap it up there. I think it's tough to end with some of the risks, some of the downsides to the economy, and I think there are some substantial risks. I think energy being a major risk, certainly a lot of the uncertainty that we're seeing in the stock markets globally in terms of economic conditions is also a risk to the outlook. But overall, I think the outlook is fairly positive for Colorado. We're not anticipating the same pace of employment gains that we saw in, say, 2013, 2014, but still expecting a pretty healthy gain, pretty broad-based across industries, with tourism, construction, some of the services sectors, high tech, kind of leading the way in that growth. Thank you very much.
All right, good evening. My name is Min-Young Son. I'm a co-founder and portfolio manager at AeroPoint Partners, and we're really pleased to be a sponsor of tonight's 2016 annual forecast dinner for the CFA Society of Colorado. Forecasting, as you know, and as Dr. Felix has shown, can be a very challenging job, and particularly in this environment, I can't think of a maybe more impossible, or maybe perhaps stated a low probability task in this environment. For many of us in the audience today, I think there's growing recognition that the investment landscape is changing and will continue to change, and introduce very different headwinds and tailwinds that we have grown accustomed to in our financial analysis. In less than 20 years, some of the following shifts have taken place. First, in terms of interest rates, it's hard to believe that 20 years ago, 1995, US 10-year rates traded between 6% and 7%. Fed funds were at 6%. And in terms of personal experience, I still recall in 2007 buying a certificate of deposit from JP Morgan Chase for 4%. And today, I'd have to be a senior lender to a company leveraged over 4 times to earn that same type of interest. Emerging markets, for a long time, were considered to be the economic engine of global GDP growth. And as we've talked about at the previous presentation, a real question mark right now in terms of weighing down global GDP. The dollar index, US dollar strengthened from about 90 to 120 into peak 2000-2001, and then fell to 80 in a period of about 12 years. And now, again, we see with a lot of the global uncertainty around the world, the dollar strengthening. What impact will that have in terms of the markets? From outside of these secular shifts, we also see very big industry and technological changes. Technology, again, financial press about 15 years ago, as internet was first growing as a medium of communication, thoughts and talks and articles of Amazon.bomb has really turned to Amazon everywhere, really destroying and putting a lot of tremendous pressure on the retail trade. Then finally, also in energy, price cycles back in a big way, and we're also seeing signs of energy taking a role geopolitically in ways that we perhaps have not seen before. Along the way, QE has resulted in a $4 trillion Fed balance sheet, and just in time, we're about ready to hashtag liftoff. Year-to-date results have been not good. S&P and Dow Jones indexes are down 8%, that's the year-to-date number, and in other areas, Shanghai down 15% in CNY terms, 16 in USD. Europe is down 9%. And incredibly, Brent is down 22% year-to-date to $29. And we exited last year and entered this year at 37. So for a period of 2011 to 2015, where Brent averaged $97, it's amazing to think that's a 200% price move up from where we are today. So in many ways, this really is a perfect night for a 2016 forecast dinner. And with all these moving parts, I'm so excited to introduce to you a gentleman who really doesn't need any introduction. He's the founder of Grant's Interest Rate Observer, an amazing, high-quality, premium subscription product. And also the winner of the Hayek Prize in the books that you have on your chair. Ladies and gentlemen, tonight, we have someone better than Dr. Copper. We have Mr. Jame Grant. Thank you.
Why, thank you. The air is thin, but the hospitality is thick. And I'm grateful to be here on this, the beginning month of I guess the year of the Value Restoration Project is underway, which is a good thing for you value investors. Well, I have chosen to call my remarks tonight Learning by Doing. And I've stolen this line from the former chairman of the Federal Reserve Board, Ben S. Bernanke, who deserves it. That is to say, he deserves to have this line stolen. He gave a talk at the annual monetary cookout and barbecue of the Kansas City Fed. Dr. Felix is a member of that organization. And by the way, anything I say about the Fed, I had one of these pink Denver drinks, and I'm just going to say anything about the Fed. But I do not mean to incorporate Dr. Felix, even by reference. But at the Jackson Hole event in 2012, Chairman Bernanke said that the following. He said that, the jobless rate had, in the darkness of the sorrows of 2008 and 9, had risen from something like 6% to something like 9%, and at length peaked at 10%, and the world was horrible and getting worse. And, quote, he says, as the crisis crested, and with the federal funds rate at its effective lower bound, the FOMC turned to non-traditional policy approaches to support the recovery. As the committee, the FOMC that is, embarked on this path, we were guided by some general principles and some insightful academic work, but with the important exception of the Japanese case, limited historical experience. As a result, central bankers in those in the United States and those in advanced economies elsewhere facing similar problems have been in the process of learning by doing. Now, was this a confidence-inducing phrase to you, learning by doing? One can learn through logic, one can learn through, I guess, through rote memory, one can learn through reading and historical study, but learning by doing seems awfully improvisational for the central banker of what was formerly the world's biggest economy. Well, indeed, it has been a learning experience for all of us. What have we learned? I intend this evening to enumerate 6 or 8 or 16 or 60 points, depends on the timing. And I want to enumerate the things we have learned, the things we have not learned, and the things we might expect in the future. The future, of course, being a closed book, but we must guess because that is the line of work we have chosen. Goodness help us. So the lessons, to me, start with the basics. What we have learned starts with the basics. And the most basic fact to me that has come out of this monetary improv is a fact we might have considered in 2008, namely that an interest rate is a price. And CFA's not just any garden variety price. Interest rates, what? They measure financial risk. They define investment hurdle rates. They help to discount projected future cash flows. These are not the price of string beans in your grocer's freezer. These are critical prices to set the equilibrium of the world's finances. Well, the experience of the world, it seems to me, is quite clear that the truest prices are the ones that markets discover and not the ones that governments administer. We at Grant's Interest Rate Observer, yeah, we don't have any interest rates anymore, which is a business model problem we have at Grant's, but we at Grant's are in favor of, farm-to-table interest rates, organic. Free-range, non-GMO. The kind of interest rates you can take home to your mother. That's what we want. And by golly, that's what we're going to have. But not yet. So price control is a policy that, as far as I know, can show no lasting success in all the millennia in which misguided governments have attempted it. And yet, if one were to speak the plain facts, is the policy that the Fed has, not you, Dr. Felix, is the policy the Fed has implemented these past 7 years, is it not a policy of price control? Oh yes, I know we have had low interest rates in the past, and indeed we have. Longer and long bond yields were in the realm of 3% and 4% and even lower throughout much of the 19th century. They were this low in the 1930s, 40s, and 50s, indeed even into the 1960s. Walter Bagehot, the famed Victorian economist and financial commentator, who's one of the first editors of The Economist, said with reference to the national figure of Great Britain, he said, John Bull can stand anything, but he can't stand 2%. Meaning, of course, that when opportunity cost of capital is set so low as 2%, people will do anything to extract a return. I mean, anything. They will invest in canals after railroads have become self-evidently the industry of the future. They will invest in imaginary Latin American republics, all the story of Victorian finance. So low interest rates have been a feature in our financial history for decades and decades in the past. What I submit to you is rather new under the sun is governmentally sponsored asset bull markets overlaid on administered low interest rates. That is novel. Now, the combination of these things has had rather pleasant effects. I mean, by the way, I too am bullish on the state of Colorado. It's the other 49 that worry me. The effects of ultra-low interest rates are, well, they come in two distinct flavors as we at Grant's Interest Rate Observer observe them. We see two things. We see one, that these unnaturally low interest rates pull future consumption into the present. That's one. And the second is that they push the recognition of business failure out into the future. So these low rates have a temporal effect, right? They work in time as a clock. Let's take the first case first, that is to say the pulling of consumption that would have been done in the future into the present. Well, you can see that, for example, and you can see that in automobiles. The average term of the average car loan is 67 months, the longest ever. Lease transactions occupy the largest percentage of auto and truck dispositions ever, I think 31%. The lending rate on the vanilla 48-month auto loan is about the lowest ever. Terms and conditions are about the easiest ever. No credit, no problem, they say on the radio, and indeed it is true. Should it surprise us that selling rates in autos and trucks late last year reached 18 million, the highest in what, 15 years? A dozen years. Well, is this consumption that is thoroughly wholesome, or might not it be consumption tinged with the rather unsightly brush of price control, that is to say, of interest rate suppression, or at least of interest rate administration? It seems to me that there's something fishy about the auto and truck business and about the business of financing those hard goods. You don't have to look very far in this state, certainly, for some of the initially pleasing, but ultimately distorting effects of artificially low rates. Look at the production of oil and gas, the prices of oil and gas. Stan Druckenmiller, who gave a talk at a recent grants conference, said something to the effect that if you give enough Texans enough free money, they will punch enough holes in the ground to surface the fatal marginal barrel of oil and MCS of gas to tilt the marginal price of those fuels into what the Federal Reserve regards as the era of deflation, depression, and despair. That will happen. It did happen, actually. So I mentioned that we think at Grants that there are two temporal features to these rates. One is the pulling into the present of future consumption. The second is the masking of the symptoms of business failure and the pressing of that failure, the recognition of that failure into the future. Now, do you remember a business called Radio Shack? I want to give a plug here to a competing publication. It's called The Onion. It's like Donald Trump today said, the art of the deal is a way, way, way second behind the Bible. He said, it's not even close to the Bible, addressing the evangelicals in Iowa. Said Trump. In 2006, the Onion ran one of its famed front page interviews, interviewed the president of Radio Shack. And the gentleman's name was real, the office he held was real, the company's name was real, the ticker was real, the interview was fake. However, the substance of the interview was spot on. The CEO was quoted as saying, you know, I have no idea how I hold this job. How the heck can we sell enough extension cords to compete in this age of digital electronics? And it turns out they couldn't. However, on the date the Onion published this wonderful, explosive interview, Radio Shack covered fixed charges from EBIT like around 6 times or 8 times. The stock was a $40 stock. It was an investment grade credit. And for all the world knew, it would last another 80, had been founded in 1920, so it was around for a long time. For all the world knew, and for all the credit markets were able to guess, Radio Shack was for the future as well as the past. It was not. It was a goner. However, owing to easy access to credit, it survived perhaps longer than it should have. Now, ladies and gentlemen, for my sins, years ago, I was a general partner in a fund that bought Japanese value stocks at less than net current assets. The business was valued for less than net cash in the balance sheet. And don't you know that those businesses remained as value-laden in year 12 of our partnership as it did in year 1? Creative destruction is an integral portion of capitalism. As in the forest floor, there is life, there is death, and there is rejuvenation, but there must be failure. Through the institution of QE, ZERP, TWIST, and the other unholy siblings, we have suppressed the recognition of failure and persisted in suppressing evident risk. So where was I? I was giving a sermon. All right. So yes. So where does this leave us in practical terms? Here we are, money-making men and women. We want to know what's going to happen next. Wouldn't that be nice? We at Grants, I've been at this for what, 150. My readers who are here, there must be 2 of them. My readers will. I have proven to them that we can't know the future. The future being a closed book, but we in this business must at least take a guess. So I'm going to spend the remainder of my 3 hours telling you about how we are looking at the future and how this might actually translate into opportunity and risk. So I would like to tell you a little bit about a specific name or 2 by way of illustration of where we stand with respect to credit and interest rates and where I think we might be going. And the case study in question is a company named Kilroy. It's a real estate investment operation. KRC is the ticker. And it is one heck of a company, as you can tell by its very fancy valuation. It is, the market reveres it, trading at almost 17 times funds from operation, yields 2.5%, much more highly valued than most real estate investment trusts. It's an office real estate investment trust, and it does business on the West Coast. It specializes in tech, San Francisco, Seattle, Ventura County, LA, and the like. It had a glorious 2009 and onwards because it bought at the bottom in 2009 very forehandedly. The thing about Kilroy is that to us, it is one of the microeconomic points of observation on the consequences of low rates and on the significance of low rates for the immediate future of business activity, interest rates, and the currency exchange rate. I say this because Kilroy is doing business with tech companies that have been sustained through the hospitality, indeed munificent generosity of our ZERPy and QE-like world. There must be more than 100 of these companies that, in the social media world, oh, I should have said space, in social media and the internet and the like in the cloud. 100 or more of these that had, or have, or perhaps had imputed public market valuations of $1 billion or more. Not a few of these, of course, are tenants. Kilroy's offices are leased up almost full. They are getting higher and higher rents. We think that Kilroy is an interesting observation on what might lie ahead. Now, we think there's a counterpart of Kilroy in Houston. It is called Cousins Properties, K-R-U-Z, or Cuz. Anyway, Cousins Properties. And Cousins derives 40-odd% of its top line from the Houston-based energy business. And as you might imagine, the stock has been rather harshly dealt with. So we think that Kilroy is something to watch for the possible unraveling of the valuations that have been sustained through the agency of Fed-sponsored low interest rates and Fed-sponsored asset price levitations, not least in the realm of real estate, where, as you might have been reading, thanks especially to Green Street, which has great research on this, cap rates on the relevant Green Street real estate index have now traded through or lower than investment-grade bond yields, which happens very, very infrequently. And last, it happened in the fatal year of 2007. So Kilroy, we think, is, by the way, this is, as I guess I mentioned, is one of the aristocracy of the real estate business. It has distinguished itself in management and in judgment, except this time, its development pipeline is immense. It is like 22% of its assets in place versus 5% in 2007. So Kilroy is all in on more of the same. It's all in on more of the same. Is more of the same in our future? Well, if I read the consensus of interest rate guesswork correctly on Wall Street, what the world thinks it sees is the famed liftoff. The Fed on December 16th did what it had not chosen to do in the previous almost 10 years. It raised its little tiny, nearly invisible rate to 0.25%, and the earth has trembled. Now, do you wonder why? Do you wonder why? How is it that the merest perturbation in a not very significant money market interest rate has shaken the world? Could it be that the very distortions that have been wrought through ZERP and QE and the rest have disarrayed and disarranged the architecture of American enterprise such that any tightening of credit conditions is enough to set us back? I think that's the case. You know, the Fed set out in 2008 to lift up consumption through the so-called portfolio balance channel. Portfolio balance channel. Very impressive sounding phrase. Trickle down, think trickle down for Democrats. The idea was that rising stock, bond, and real estate values would stimulate consumption on those who owned assets, and their consumption would, as it were, infect the animal spirits of others, and we would be off to the races. But finance is nothing if not reciprocal. If you stimulate consumption through low interest rates, do you not reciprocally stimulate the supply side of the equation? Might you not stimulate the production of the aforementioned fatal marginal barrel of oil and MCS of gas? Well, it seems that that low interest rates have done approximately that, and we are in a world with a great deal of debt, a great deal of supply, and a great deal of angst. Well, there's got to be a way out of this. And I think I know what it might be. I think I know what it might be. Because people have been around money for almost as long as they have been around dogs. Little is ever truly new under the sun of finance. But what might be new is what we at Grants call the PhD standard, not you, Dr. Felix, the PhD standard of monetary management. Now, this might be that rare monetary novelty. The PhD standard, of course, is the regime in which former tenured economics faculty make the decisions. They are the deciders about interest rates and credit conditions. Now, ladies and gentlemen, I invite you to think to your principles class, Economics 101. I hope you didn't go beyond that, otherwise I would worry about your professional futures. But is that avuncular, helpful, and perhaps lucid professor, is he or she the one you want to decide what the clearing funds rate is? Well, it's a lousy question and an unfair one. My sense is that if interest rates are prices, and if prices ought to be discovered and not imposed, then perhaps it's best if no one holds this office that our PhDs in the Fed now hold, but the office is in fact filled. It's filled with former college faculty. And perhaps the professors have lost a little bit of touch with the world, by which I mean perhaps they have not noticed the collapse of the junk bond market. Perhaps they have not noticed, as they might have, the break in commodity prices, nor the collapse in the so-called emerging world, nor the flattening of the yield curve, nor the preternaturally favorable experience of credit on bank balance sheets, almost as if credit were being over-earned and there were some comeuppance in the future. Perhaps our faculty members have not noticed these things, but if you're in the market and being marked to market, you can't help but notice. Now, I say to you that I believe that our monetary mandarins are innocently guilty of a kind of a guileless devotion to their models, their macroeconomic models. It was about a year ago that we in New York received a weather forecast on a Friday, and came over the radio, and radio forecast said that Monday would bring the biggest blizzard in Manhattan since the arrival of the Dutch in the 17th century. Whew. Well, it was okay by me. I love blizzards. And my wife and I made plans to watch it as it began. We had a reservation for Monday evening, the appointed hour, at a local restaurant with a wonderful picture window, and arrived early, had a drink, and prepared for the show. As the evening wore on, we couldn't help but notice that it wasn't snowing. Now, the weathermen are human. I mean, for Pete's sake. I mean, they missed by 50 miles. But consider, as beautiful as a snowflake might be, as precious as it might be, it is inanimate. It does not surf the web. It does not confound the forecasters by changing its mind because its neighbor got a cash-out mortgage. No, snowflakes just do what they're going to do. And the weathermen, women, have how many big data observations of similar wind and air pressure and the like patterns might they have had at the National Weather Service? I don't know, 10, a million, a billion, many. The weather people missed. And yet, Mario Draghi could get up before the assembled at the Jackson Hole monetary event, 2011 maybe, and say that what especially concerned him, said Mario Draghi, to the straight-faced and nodding and solemn audience. What especially concerned him, said Dr. Draghi, was the 5-year forward inflation rate. You know what that meant? It meant he was worried about the rate of inflation beginning 5 years hence for the subsequent 5 years. Now, how the heck could anyone know that? I invite you to imagine yourselves in the boardroom of a German bank in the spring of 1914. You are assembled there for a regular meeting, the chairman of the bank to encourage the give and take of ideas, invite you all to imagine the future of German finance. In the year 1919, for the 5 years since, Herr Schmidt, what will the rate of inflation be in Germany? And tell us about the status of the bank and about the soundness of the mark, which is now as good as gold. Here's what Herr Schmidt does not say in response to this question about 5 years from now. He does not say, Herr Chairman, in 5 years, Germany will lie devastated, defeated. The bank will be insolvent. Most of us be dead. And the inflation rate in 1922 will be 218,000 million % per annum. The mark will be as dead as many of our confreres at this table will be. That's what he didn't say, because no one can know the future. Nor in 1961 did anyone say in Hong Kong to Sir John Copperthwaite, then the financial secretary of Hong Kong, no one said to him, Sir John, if you persist in these seemingly antediluvian free market policies, which he would do, in a generation, the average incomes in Hong Kong, then 1/4 of the mother countries, would surpass those incomes in Great Britain. No one saw that coming either. We can't know the future, either good or bad. The future is discontinuous. If it weren't, think how rich we would be. We'd just do what we did yesterday. All right, so this is setting us up for the forecast. Yeah. Hold your applause till next year, please. Okay, so the PhD standard, I was saying that half an hour ago. I was saying never before have we had quite this regime in central banking. You know, William McChesney Martin, who served from 1951 to 1970, longest serving Fed chairman, would not have a PhD economist on the staff except for Dr. Felix, who does not look her age. She looks 20, but she's actually she's Dr. McChesney Martin's economist. He would have her, but nobody else. Martin would not have economists because he wanted to, he was a real world New York Stock Exchange guy. His judgment was not always perfect, but he was a kind of a tactile reader of markets. He would not have the economists on the staff. Now they are ubiquitous. Indeed, they run our policy. So if I'm correct in thinking that the December 16th rate hike was a titanic error, which I do, the data-dependent improvisational approach to policymaking might just come in for a long overdue reappraisal. So what I think is that far from raising the funds rate 4 times this year, as many still seem to believe, I think that the Fed will in fact revert to 0 before it reaches 0.5%. That's my story. I'm sticking to it until the facts change, in case of. So be that as it may, let me read you a couple of lines of what we actually said in November, and this will set the scene. So the FOMC had said here in Grant's meeting on December 16th, will lift the funds rate from 0, having to choose between a loss of institutional face, because how many times has it hinted that this time it will act, and the mounting evidence of weakness in the American economy, except for Colorado. Yellen et al. Will choose face. Markets will register no immediate objection. They've had years to get used to the idea of a funds rate just a little higher than 0. Now, trouble follows, we were saying in November. The passing months will reveal that there is, again, no liftoff, but rather a dwindling in the economic and financial vital signs. Mortified at what is looking more and more like an unforced policy error, the mandarins will return the funds rate to 0. In speeches, they will drop broad hints about some new round of experimental monetary measures. The dollar bulls, participants in what the Bank of America Merrill Lynch recently identified as the world's, quote, most crowded trade, will have already acted. They will have beaten the Fed to the punch by trading in their greenbacks for euros, Swissies, and other alternatives, including the seemingly hopeless one that can be found in the periodic table of the elements. All right, that's what we said in November. And so the future, as I guess I asserted, is a closed book. So we must guess, and our guess is that the funds rate will return to zero before it reaches 0.5%. The Bank of Yellen, taking the measure of credit of the stock market, of the commodities markets, of the world, will say uncle, to the vast relief of global markets. I can imagine how the removal of the threatened 2016 rate hikes would or will play among the shell-shocked owners of risk assets. And by the way, are there any other assets except risk assets? I'm thinking especially of bonds. A bond, after all, is a promise to pay money. You know, many years ago, when QE was still rather a novel idea and rather a mystery, the Financial Times of London published a letter to the editor. It said this, it said, "Dear Sir," it said, "I believe at long last I understand the meaning of the phrase quantitative easing. What I no longer understand is the meaning of the word money." Well, one does wonder. Today's dollars are only X's and O's. You can materialize them at no cost at all, no sweat on a computer. You can, indeed, we do materialize them by the trillions. Can this digital emission truly be a store of value? In closing, I wish to thank especially Denver Investments, Wisdom Tree, ALPS, and OFI Global. I see that they are the gold sponsors. So thank you, ladies and gentlemen. Thank you. Thank you very much.
Well, Jim, Allison, if you wouldn't mind, we could do a brief Q&A session, if that's all right. And I believe we'll have 2 roving mics going throughout the audience, and while we get those going, I'll throw out a question or two that I jotted down for both of you. I'll be gentle.
For God's sake, do this.
Jim, I'll start with you. As a recovering economics major myself, are there any positives that you see out there in terms of, and not to say that it was all negative, but where, in your opinion, a rate hike might stick and or be warranted?
I'm sorry?
So what positives would you need to see out there for?
I mean, there's always something to do. I mean, we always have a long, we always have a short, or generally speaking, I try to see the world as I believe it is. I don't try to be constructive or destructive. I try to see things as they are, and sometimes that's easy to swallow, and sometimes I guess it's more difficult. But I mean, for example, it's a truism that the destruction of price and the coincident destruction of capital, however painful it is for the holders of those assets and the expectations that holders of assets similarly hold, is immensely bullish for the future. I mean, with every shut-in rig with every bankruptcy, as gruesome as it is, Mr. Market is setting up for some wonderful new upcycle in some form of energy. And we are looking around for opportunities. They're looking around for opportunities in emerging markets. There's all sorts of things to do in the world. I mean, I think that that falling prices are, of course, good for the short sellers, that hardy and antisocial bunch, but they are also food for the value set. And again, it's a tautology of investing, but risk comes out as prices fall. Risk is high prices, no? I mean, we ought not to fall into this trap that you see in the New York auction houses. At Sotheby's and Christie's, they auction something at some stupendous and stupid price, some Jeff Koons or some grand contemporary artist, and if it's a record price, they break into applause. No, you don't applaud high price, you applaud value. And I was only being half tongue-in-cheek by talking about the value restoration project that's happening. And this is the time where people really make money. Not necessarily this week or this month, but this is the setup for a terrific span of investing. And I'm not sure when it begins, but I've never known. But because I'm wired differently. But the lower prices go, the more excited I become. I think this is it's hard, but it's going to be something. It's going to be great.
Allison, I couldn't help but notice that one of the negative pieces for Colorado was the tech sector. I think in employment it had dropped just a little bit in the November numbers. Do you think that's much of a risk for our economy and your colleagues in the San Francisco Fed? Have they seen anything on their side? There's certainly a much bigger tech area. Is there any broader concerns of a tech bubble?
Sure. So I think you're referring to a small decline in the professional and business services sector, which would include some of the technology workers. I think the small decline here is probably driven more by those in the energy sector that are related to that sector and less on the tech-specific side of things. So I think, at least currently for the Colorado area and extending west, I think not a huge risk of a bubble in the tech sector, although certainly it is a sector that's been expanding quickly in the area.
Okay. Do we have the mics out in the audience? I think Elias and Phil. Oh, got one over there. All right, so first question over here.
A question for Jame Grant about prices, observing prices that might be moving in different ways. One thing I've noticed is that the gold-oil cross has reached kind of extreme levels here, kind of charting at least a ratio of gold and barrels of oil going back to at least 1961, right extreme at about 40 barrels of oil that can be purchased for an ounce of gold. I think that's basically double to triple versus what we've seen historically. I know you said it's hard to kind of predict the future, but what would this tell you about maybe some of the pressures you're seeing, whether it's the dollar or commodities or something else?
I'm sorry, I heard much of that, but not all of it. I wonder if you might translate.
Sure. So it looks like the ratio of oil to gold is at a fairly high, you said 1961, 50-year high. So the number of barrels that can be purchased by an ounce of gold. Does that?
Well, I think it tells you more about credit than perhaps it does about oil, or even for separately gold. You know, it seems to me that that the bear market in oil is a product of two distinct forces. One is human ingenuity and the fracking technology that has been such a boon, and the second is junk bond yields beginning with the number 4, which briefly took place a couple of years ago, or fairly recently. So almost unprecedented access to credit facilitated the implementation of great new technology, and that has given us, I think, this really quite stupendous bear market in energy. As to gold separately, gold is to me one of the great flummoxing questions. You know, people say, what's your best idea? And, you know, of course, you always know that 2 years later. You don't know at the time. And you know, when I was a little bit younger and much more certain about the future, I always blurt out what I was most excited about, but I become cagey. But I will confess to my friends in Denver that the first thing I look at on a screen is gold. I am again, as to intellectual or emotional wiring, I believe that gold is money, and I can't believe that the world doesn't see it my way. I can't believe that the world doesn't take the measure of the arbitrariness of current monetary arrangements and come to the conclusion that perhaps they are not for forever, and that the world will reconsider the nature of our monetary arrangements and find some place, official place for gold, as it has for many hundreds of years, indeed millennia past. So the gold price to me, loitering at less than $1,100 as the currency wars seem to be resuming, as China seems to be on the verge of some massive devaluation, as Mexico invites the emerging markets to emulate the developed markets in implementing something like QE, as I think the Fed is going to have to renounce its plan to raise rates. As all this is happening, gold is languishing as if fiat currencies were the final answer. So I am a very thwarted and vexed and frustrated holder of gold and gold mining equities. It's not all I own by any means. It's not a commanding part of my portfolio, but it's something I think about a lot and something that flummoxes me. So when I'm asked about the ratio of oil to gold, boy, do I ever not know. I don't even know why gold's doing what it's doing, let alone, I think I know what oil's doing and what it's doing. I can't explain what gold is up to.
You spent a lot of time talking about interest rates and how they're set and what the markets have done or not done because they've been ruled by the government. What do you think the right rate for the stock market is, or what should the yield be on the S&P 500?
Yeah. As to interest rates, you know, the Sidney Homer wrote his book, The History of Interest Rates. It goes back a couple of thousand years and traces rates through all eras and ages. And Sidney Homer kind of concludes that the average interest rate, at least in America, you know, since the founding of the country, was 6%. That's the average American interest rate, 6%. And that's kind of a composite of government yields and high-grade corporate. And now it's varied considerably. I don't know what the average, what the correct interest rate would be in these conditions. Hence the need for discovering rates. I will observe that in the Great Depression, rates were not this low. Certainly, there were no such thing as negative money market interest rates as we have now seen in Europe, and as Stanley Fischer, the vice chairman of the Fed, is talking about now, as if it were a possibility for America if things continue along these lines. So I don't know where rates ought to be. I observe that they are much lower than they have been. And from this, I kind of conjecture that they ought to be slightly higher than they are now.
I guess my question was more on a relative basis, stocks compared to other asset categories.
Yeah. So where should the stock market be?
I would say it that way.
Well, you suggested it. I don't know. I think it's going lower, but that's not your question.
Given that we have prices fixed on bonds, the yield of the stock market seems unusually high to me relative to the bond market.
Yeah. Well, it's hard to say. I mean,
There, you got me to tip my hand.
yeah. I mean, in 1958, there was a great event in American finance. In 1958, for the first time in anybody's memory, stock yields traded lower than bond yields. and people scratch their heads. There's an article, if you please, in Life magazine to commemorate this fact, or to ponder it, to noodle it. And the author of this article in Life magazine had exactly the right call. He said that times have changed, that in times past stocks yielded more than bonds because stocks were thought to be riskier. But in fact, in this day and age of the Employment Act of 1946 and of the evident chronic imbalance in federal finances during the Eisenhower administration, when the budget was in fact largely balanced, he said, in view of the changing times, it's not so unreasonable that stocks ought to yield less than bonds, and perhaps we are embarked, this is not his words, but perhaps we are embarked on a great bull market. And that was precisely what was happening. That's from Life magazine. So you never know where these relationships that seemingly are fixed are going to change. I don't know where stocks ought to be. It seems to me that, that if interest rates are artificially suppressed, and I think they are at the margin, and if the stock market is valued on some discount, some discounted cash flow measure that takes particular, that assigns particular weight to market interest rates, then to that degree the stock market is overvalued. And to the extent that these rates have upset the structure or the architecture of American enterprise by pulling consumption forward and by distorting the effects of business failure, the recognition of business failure, to that extent the stock market is overvalued because companies are going to earn less. So that is my somewhat fractured non-answer to your excellent question.
Back over there.
This might be best addressed to Allison, but an acquaintance of mine moved here last year, and he was telling me today that he was waiting around to buy a home until home prices drop in Denver. So I might like to tell him when the Fed would say would be a good time to buy for him. How long is he going to have to wait, based on the data you presented?
Well, certainly it won't be the Fed's view, but in my view, I think you hear a lot about that in the Denver area, just with the quick home price appreciation that we've seen. I think there's a lot of forecasters out there that are predicting somewhat of a correction in home prices. I guess the one thing that I would point to, though, is that inventories remain very low in the area. So I think as long as we see home inventories at 1.3 months supply in Denver, it just indicates that there's just going to continue to be a lot of upward pressure on prices. That's not to say that they won't come down or correct at some point, but I think first we need to see inventories start to get back to a healthier level, closer to maybe a 4, 5, 6 months supply of homes on the market. And construction activity is increasing. It's increasing, though, at a fairly modest pace, given the number of years where we saw very minimal construction activity. So given the migration that we have coming into the area, given the future demand that we see for homes, I think probably home prices in the area are likely to not see a lot of downward pressure, at least in the short term.
I call that bullish.
Sounds like a positive to me. Right there in the middle.
Yeah, hi. Just a question for Dr. Felix. Although Mr. Grant, you can think about a bunch of things, but Dr. Felix, in your role as policy at the Fed, I'm very tempted to ask about the fixation on the inflation and driving it higher, but I'm not going to go there. Instead, I'm really fixated on the growth side. It seems to me you talked a lot about inputs and to the economy and the supply and et cetera, but monetary policy is tapped. You guys raised not too long ago, notwithstanding Mr. Grant's views going forward. Fiscal policy, there's really nothing there, and I'm not quite sure when that's going to turn. So I guess my question is 2% growth the new normal? Is that baked in the cake for as really long as we can see?
I think when you look at longer run expectations for growth in the U.S. economy, I think there's a couple of trends that are that would suggest that maybe a lower growth is likely to persist for some time. I would point out a couple. Population growth has certainly slowed. So demographic trends in the U.S. and even more pronounced globally would suggest that growth is likely to be slower over the long run than it has been in the past. And the other, I think the bigger question mark in the equation is coming from the productivity side of things. So another thing that clearly could drive faster growth would be faster productivity gains. And of course, over the last decade, we've seen fairly minimal gains as it relates to productivity. So to the extent that productivity growth remains in the ballpark of where it's been in recent years and population growth is slower than we've seen, that suggests that growth is going to continue to be slower. All of that said, though, I think there's always a risk because productivity, you don't always see it coming. So when you think of some of the big innovations over time, certainly there could be a surge in productivity gains, which could lead to faster growth. But I think if the current trends that we're seeing stay the same, I think you're right. I think we can expect that longer-term GDP growth is probably going to be lower than we've seen in the recent past.
Jim, in terms of the new tin asset, gold, I've fumbled around with trying to come up with a valuation on it, look at what mining costs are all in, sustaining costs, things like that, somewhere around $1,000, $1,100 an ounce. But then there's so many other factors, you know, whether it's futures and the role that they play. How do you come up with a valuation on gold?
Well, you don't. A gold stock is to a degree like a biotech stock, and without a drug yet in trials. To me, the value of gold is a not quantitatively satisfactory value, such as the following. To me, the value of gold is the reciprocal of the world's faith in the institution of managed currencies. It's 1 divided by faith. So to the extent that people put their faith in the stewards of the euro, the dollar, the renminbi, the yen, and other currencies, to that extent, they don't need gold. Gold is money, it's a monetary asset, and it competes with other currencies. Currencies don't yield, money yields nothing. Gold's not unique in yielding nothing. The dollar bill yields nothing. What is different is that the dollar bill has 0 cost of production. Gold requires, you have to spit in your hands and wrest it from the earth. You have to explore for it and discover it. And getting back to the capital cycle theory of investment value, the bear market in gold that began in 2011 has absolutely destroyed the exploration and development business. It has cut a broad swath through capital outlays for production as well as for exploration in the gold business. So the capacity to produce it has been much diminished. The resources to search for it have been withdrawn. There's no capital available for the gold business as there is no capital available for the energy business. Those things are desolating for the moment. They are very bullish for the longer term. Less so for gold because gold as a monetary asset has this feature. Not 1 ounce of its production since the time of Cleopatra has really been destroyed. It's been transformed from somebody's filling to somebody's ring to somebody's gold bar, but it's still around. It's not consumed, which makes it a unique monetary asset. But how do you value it? It's, it competes with money and it competes with credit, which is the promise to pay money. And what I see setting up is a crisis of credit, the promise to pay money because of the preceding 5, 6, 8 years, whatever it's been observed in QE. And I see also, I see an intellectual crisis of the nature of money. To me, it's one of the good things that's coming out of this, or difficulties with interest rates and with the central banks, is I think this will be, I think what we'll finally have is an interesting debate on money. What's money and who says so is one of the oldest questions in political economy. What's money and who says so? Well, if you can materialize $4 trillion or 3.5 extra trillions of dollars in the Fed's balance sheet without breaking a sweat, what is the nature? Is that truly a store of value? What is the nature of that dollar? What is the nature of a euro when, in order to stimulate, as it were, stimulate the European economies, they have to charge less than zero on your mortgage? Are monetary arrangements exactly what they ought to be? Are they meant to last? Are they enduring? And it seems to me the obvious answer is no. That's why I'm so frustrated about this dead-in-the-water gold price. It seems to me that the world is at a monetary moment. This is a very interesting moment in the history of money. And I think this discussion, this debate will be joined, I dare say it will not be joined by our Republican contenders, evidently will not be joined by the Democrats either, but somehow people with money will begin to say, huh? Yeah. So Janet Yellen and the Federal Reserve Board says that, as do all the central banks, say that the prices must rise about 2% a year lest we fall into deflation. Now, what is that? Is that so? People accept this as if it were writ. Since when is that true? So I think that these questions, which have been accepted broadly, without discussion, without second guessing, I think these will come to the fore. There'll be an interesting and fraught debate, and from it will come perhaps an improved system of monetary management. I think this improvisational system of this data dependency, my view is that it is being exposed now. It seems to me perhaps that we are on the cusp of a recession and on the cusp of a bear market, and on the cusp of these things, the Fed has chosen to tighten. Well, that will provoke discussion. It will provoke discussion about what these mortal human beings, just like the rest of us, who have no better knowledge of the future than the rest of us do, what are they doing what they're doing? That, to me, is the exciting prospect about money.
I think we have time for one more question.
With respect to your, Jim, with respect to your idea that the Fed is going to lower the Fed funds rate, what exactly are the drivers that give you this idea?
Well, I think the drivers are the ones that we see on the screen every day when you go to work. I mean, let me read you a paragraph of a talk that President William Dudley of the New York Fed gave in December of 2014. This is the same William Dudley who on Friday, just last week, said that they're going to raise rates 4 times this year. Here's what he said 2 years ago. Quote, financial market conditions have become a much more important factor in evaluating the appropriate setting of monetary policy and the level of short-term interest rates, close quote. The speech was all, look it up, the speech was all about how the Fed listens to Wall Street, not to Wall Street, it takes the measure of the meaning of the financial markets. What are the financial markets doing these days? The credit markets are back to where they were like in 2009. There is relentless undertow in credit here and on the continent of Europe. Stocks you know about, commodities you know about. I mean, what exactly did he mean then, and what exactly does he mean now? I mean, Janet Yellen is an empathetic person. She's a labor economist. She's all about wanting to make human lives better. That's what she stands for. I mean, if she's guilty of anything, she's innocently guilty. I mean, she does her best. How many of us know the future? Not many. So the Fed has made a human error, just like the weather forecasters in New York City a year ago. They tightened, they missed their market, as we say in Wall Street, right? They missed their market. Okay, so shoot me. So there's no human error that can't be rectified, no human error like this that can't be rectified. They'll say, okay, we made a mistake. However, the admission of this is going to cause waves, I say, because the world is long dollars, short everything else, because we know that monetary policy is diverging worldwide. That's the mantra. You read in the FT, you read the Wall Street Journal, you read the New York Times. No, says Grants. It's not true. Monetary policy will be converging on radically easy money. Yeah. Anyway, I only said it out loud. You can forget that if it doesn't work out.
Are there any last words from either of you to close out the evening, or any last thoughts? I think this has been a quite comprehensive run through. I agree. Please join me in a big round of applause for our two speakers. All right, well, feel free to finish your drinks and enjoy the rest of the evening. I know there'll be a number of folks sticking around. There is the bar downstairs. But drive home safe. Thank you for coming out, and we'll see you next year. Thank you very much.